Have you ever wondered how companies account for the wear and tear of their assets over time? This is where depreciation comes into play. Depreciation is the decrease in the value of an asset over time due to wear and tear, obsolescence, or any other factor that reduces its usefulness or market value. Let's take an example of a company that has purchased a new delivery truck for $50,000. The company expects to use the truck for the next 5 years before replacing it. The estimated salvage value, or the value of the truck at the end of its useful life, is $10,000. To calculate the depreciation expense each year, the company can use the straight-line depreciation method. This method allocates an equal amount of the asset's cost over its useful life. In this case, the depreciation expense would be $50,000, $10,000, 5 equals $8,000 per year. So, the company would record a depreciation expense of $8,000 each year for the next 5 years. At the end of the truck's useful life, the accumulated depreciation would be $40,000, which is the total amount of depreciation expense recorded over the 5-year period. The net book value of the truck, or its carrying value on the balance sheet, would be $10,000, $50,000, $40,000. Depreciation is important for financial reporting purposes as it allows companies to accurately reflect the decrease in the value of their assets over time. It also helps to spread the cost of an asset over its useful life, which can improve the accuracy of financial statements and aid in decision-making. And that's depreciation in a nutshell. Thanks for watching!